Welcome to The Explainer. Today, we're going to tackle that feeling of caution that seems to be everywhere in the markets. We'll dig into what it means for managing risk when the future just feels, well, more unpredictable than ever. Let's just dive right in with this. This quote from T. Rowe Price, it really nails the feeling, doesn't it? It gets right to the heart of what so many investors are wrestling with, that deep, nagging uncertainty. It's the question we're all asking ourselves. Is this just a passing storm, or have the fundamental rules of the game actually changed? You see, we're stepping into what feels like a new age of uncertainty. Those reliable connections between different assets, the things we've always counted on for diversification, they just seem to be weakening. It feels like the old maps that guided portfolios for decades might not be showing us the right path anymore. And look, this isn't just one single storm. It's more like a perfect storm, a convergence of all these powerful forces at once. You've got major geopolitical shifts, central banks completely rewriting their playbooks, inflation that just refuses to go away, and a global economic landscape that is just fundamentally changing. It's an incredibly complex mix that makes navigating the markets way more challenging than it used to be. So, how does all this uncertainty actually change how we behave as investors? Well, it triggers some really powerful, deeply ingrained psychological biases that can dramatically shape our financial decisions, a lot of the time without us even realizing it's happening. Okay, first up is a risk aversion. Honestly, you can think of it as a basic survival instinct. When markets get choppy and volatile, our gut reaction is to sell what feels risky and run for cover in assets that seem safer, like government bonds or just plain old cash. And then there's this one, loss aversion. It's a fascinating and incredibly powerful bias. It turns out that, psychologically, the sting of a loss feels about twice as intense as the joy of an equivalent gain. That intense fear of watching your portfolio value drop can lead to some really reactive decisions, like panic selling right at the bottom of a market dip. And this one might be the most relevant for our current environment, ambiguity aversion. Now, this is a subtle but absolutely crucial idea. We don't just dislike risk. We absolutely hate uncertainty, where the odds themselves are a complete mystery. It's that fear of the unknown unknowns that can totally paralyze our decision-making. And this slide just illustrates the difference perfectly. Risk is like a coin flip. You know the odds are 50-50. You can calculate it, you can plan for it. But ambiguity? That's like trying to predict the outcome of a totally unprecedented event. There's no historical data to model. It feels like you're navigating completely in the dark. And that feeling, it just makes you want to retreat to whatever feels certain. So this new caution creates a classic dilemma for every single investor. It forces a really difficult trade-off, right? How do you balance that immediate need to protect your capital with the long-term necessity of growing it to meet your goals down the road? I mean, holding cash feels incredibly safe, doesn't it? Especially in a high-rate world where it's actually earning a decent yield for a change. But it comes with this significant and often hidden cost, the corrosive effect of inflation, which is just silently eating away at your purchasing power day after day. You know, the investing legend Charlie Munger drove this point home over and over again. Too much caution or just the inability to stomach market downturns, it can lead to really mediocre results. Yeah, it might shield you from that short-term pain, but it often comes at the huge cost of long-term wealth creation. So the crucial point is this. Cash is an incredibly powerful tool. Let's be clear about that. It gives you flexibility, it gives you optionality, that dry powder to act when great opportunities pop up. But it's a means to an end. It's a strategic asset, not the final destination for your long-term capital. So how does this caution play out in the real world? Well, it's pretty fascinating to see how two major groups, retail investors and big institutional investors, behave so differently in this kind of environment. Their resources, their mindset, the pressures they face, they're often worlds apart. What's really striking here is the clear divide. On one side, you have institutions with frameworks and risk committees, all designed to keep those emotional biases in check. They tend to systematically build up cash and adjust their risk. But on the other side, you have retail investors who, even with access to great new tools, can be more susceptible to emotional swings. This can lead to those classic behaviors like panic selling during a downturn, or, on the flip side, a really steadfast commitment to just buying the dip without a deeper strategy. A lot of the time, the difference really comes down to resources and having a structured, disciplined process. Okay, so understanding all these forces is one thing, but recognizing them in our own behavior, that's the really important next step. Let's just take a moment to reflect with a few quick diagnostic questions. This is a classic symptom of loss aversion in action.
I mean, research consistently shows this strong tendency for individual investors to postpone the pain of realizing a loss, clinging to hope long after the strategic reason for owning something is gone.
Now, if this one sounds familiar, it points directly to ambiguity aversion. It's that retreat from the unknown, that flight to the perceived safety of cash, even if it means totally abandoning a well-thought-out long-term strategy. And this last question, it gets right to the heart of herd behavior. It's that powerful, almost magnetic urge to just follow the crowd. And while it can feel safe to be in the middle of the herd, this is the exact behavior that amplifies both market bubbles and those really painful crashes. So, what's the key takeaway from all of this? What's the bottom line? In a world that's just defined by uncertainty, the most powerful antidote to reactive, fear-based decision-making is intentionality. It's about moving from instinct to strategy. So what's the path forward? Well, leading firms like Schroders and BlackRock are highlighting that this is just not a time for passive, set-it-and-forget-it investing. It's about being an active participant. It means being selective, staying adaptable, and I love how BlackRock puts it, owning your risk deliberately, instead of just spreading it around without intention. It's about having both flexibility and conviction. So we'll leave you with that final thought. It's a really crucial question to consider, and a reminder that in the long-term pursuit of your financial goals, the risk of inaction and excessive caution can sometimes be far, far greater than the risk of deliberate, well-considered action